All right, let's get started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, we will be kicking off with the major equity indices as usual, highlighting some of those key levels. We are seeing price for the major indices run into some levels of resistance, but overall still staying quite neutral. From there, we'll be moving on to fixed income and commodities. We'll also take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the broader market. We'll take a look at some subsectors of interest, and we'll end today's webinar with some bullish and bearish market observations. So taking a look here at the S&P 500 using the SPY ETF, we can see that price has been quite neutral, at least in the last 2 weeks or so. Initially, we saw a rally at the beginning of earnings season towards 460, but price did manage to decline. A lot of that due to fears of Chinese data not coming out quite as good. And that did see a broader global decline, really, in equity markets. But we have seen a recovery, but price again struggling to break above that 453, mid 450s area, and kind of pulling back once again to form now what I would consider a higher low. So yes, the overall direction over the last month or 2 months even has been quite neutral. It hasn't really, we haven't seen price breaking to new high territory. But we are seeing in the last couple of weeks that price has now formed a higher low and is now looking like it will be squeezing that 450 level of resistance. So usually what happens in this case is something similar to what we saw in the past, where we saw initially a bit of a rally, but neutral price action followed by another rally. In this case, we've seen that rally here, a significant rally, all the way to 460, followed by a pullback, yes, but still I would consider this to be consolidation, because the overall structure or the overall bullish structure is still very much intact. Price is still making higher highs and higher lows. And to get a better idea of that, all you have to do is look at the weekly time frame, where even though we're seeing a bit of noise in the last couple of months, the overall structure is still that of higher highs, higher lows. Price looking at pulling back to pretty much near 430, finding some support, and once again pushing higher. So based off this chart alone, it does look like we'll eventually see sooner rather than later a breakout above that 455, 460 area and a continuation higher towards 480. So still maintaining a bullish view for the S&P 500, but definitely less bullish than maybe, let's say, mid-June, early July, where we saw a very strong rally. I think there has definitely been an overall decline here in momentum. And, it doesn't necessarily mean we're in for bearish territory. It just means that there's a slowdown with this overall rally that we are seeing. Moving on to the NASDAQ 100, and apologies for the momentum chart. I'm not sure why, but it didn't load correctly when I took the screenshot. But for the NASDAQ 100, we are seeing, I would say, some underperformance of the NASDAQ 100. Technology stocks don't seem to be doing as well. I'm looking at lower highs on the daily time frame, but all in all, the S&P and the NASDAQ 100 do have a strong correlation. So you don't want to look too much into the differences between the S&P and the NASDAQ 100 when it comes to correlation. You normally just want to look at outperformance and underperformance. And right now, the NASDAQ 100 is slightly underperforming the S&P 500, but still showing very similar price action. Key area of resistance is at 380. Price is hovering at that level. And for clear breakout, I'd like to see price actually break out and close above the 390 level. That would give me the evidence needed and warranted for continuation higher here towards 410. But for now, the NASDAQ 100, like the S&P, still bogged down by some resistance. But again, price on the daily time frame is seemingly moving higher here with higher lows. And we could also see a potential breakout in the next couple of weeks. Okay, small caps, looking at IWM, the Russell 2000, and here we can see the real underperformance relative to large um, cap names. Sorry, is everyone able to hear me? I'm just seeing some comments on no audio, which is the one comment. Please, again, apologies, but type a one into the chat window if you can hear me. Yeah, I'm sorry, Donald. I'm not sure why you can't hear me, but everyone else seems to be hearing me. Could be just a volume setting. Anyways, apologies for that. So back to small caps. Like I said, we've seen a good bit of underperformance here during a time in the last week and a half when price has continued to move higher for the large cap names. We're actually seeing small caps turn lower despite initially breaking above that 188 level, which again is a 38.2 fib level, which we know based on the last few months, very important level to be looking at. Now, the next key level of support sits between 182 and 180. So price does look like it's heading towards that level. And, given the fact that broader markets are actually showing small signs of strength, we could see IWM actually bounce high from this level. And this level very much validates itself as support once again. But the fact of the matter is, we are seeing significant underperformance. And if you are looking at the major indices to invest in, I think you're still better off allocating your money to large cap indices like the S&P, like the NASDAQ, because right now we are seeing small caps still continuing to underperform. And for the last couple of years, really, we haven't seen a long period of time or significant amount of time of outperformance for small caps. Yes, there's been maybe a week, maybe 2 weeks in a row where small caps are outperforming, but it hasn't been able to maintain that outperformance relative to large cap names. And for that reason, I do not believe that small caps are a good investment from a timing perspective right now. I think large cap names are just performing that much better and are a lot more consistent relative to small caps or small cap indices like the Russell 2000. All right, TLT, the Treasury Bond ETF. I was looking at this chart earlier today, and throughout the whole year, I've always said, and for those of you that have followed me through the last few months, especially, I've always said that TLT provided very good shorting opportunities for me personally, but I'm sure for many of you as well, because very early on, we were able to identify that 108 level. And I'm talking about, January, even December last year, we were able to identify that 108 level as a potential level of resistance, and that level held on to resistance, very comfortably, and it provided some excellent shorting opportunities throughout the last few months, especially if you're looking at credit spreads as optimal strategy for this. But what we eventually saw was price actually forming a new key level at 104, minor support turning minor resistance, and again, still providing some opportunities. So the overall thesis remained intact of you shorting at resistance, right? But now we saw a significant breakdown. I mean, that was a huge breakdown where we saw the 50-period CCI almost touch minus 400. Minus 200 is an oversold condition. Minus 400 is extremely oversold. So, it didn't make sense shorting when 50-period CCI was that low, but it does make sense shorting when price has shown the same price action as it did over the last few months, which is identifies a potential area of resistance, which in this case would have been around 97. And the last time we spoke, I did say, wait until price reaches that point. If we see some bearish price action, that's a good shorting opportunity. I know we didn't have a market outlook last week, but we did see that bearish price action at 97, a strong rejection of that, and again, price moving lower. So I don't think right now is a good time to short TLT because, again, you want to see a revisit back towards the 97 and then look for that shorting opportunity. In other words, you're basically selling into these short-term rallies here for TLT. The overall structure still remains bearish, and we are still seeing a complete lack of momentum for TLT. So unless we see a significant breakout above 97, above 100, and even 104, it still makes sense to be shorting at these key areas of resistance. And moving on to the US dollar, and the US dollar has made a significant comeback since the early days of July, which we saw was, a very strong decline, a bit more of a dovish response from the Fed. And what happened was, since then, we have the Chinese data coming out quite risky, investors naturally rotating towards the more safe haven currency, which is the US dollar. And we have since seen a strong recovery higher. There's actually some talks of interest rates continuing to move higher, or lack of dovishness, at least from the Fed. So there is decent dollar demand. The big question is that demand strong enough to break above 105.50? 105.50, strong level of resistance, and price is now approaching that level. So it has broken above 103.50, 104.50, but 105.50, that's a major level to be looking at. Either way, US dollar looking quite strong. Moving on to gold, looking at the GLD ETF, and gold moves inversely with the US dollar, like I said in the past, but what we're seeing here is still some underlying weakness, a bit of a bearish trend line, not a very clear trend line, but we have horizontal support at 177, which actually seems to be holding just about. I mean, the last time price was there, it looked like there was going to be a potential breakdown. Price managed to recover, but still maintaining a bearish structure, not a lot of momentum behind these moves higher, and also lower highs. So it's quite simple. You have to respect the bearish structure, and you're looking to short these rallies as well here for gold, keeping in mind that that 177 to 175 level is a strong level of support. So trading gold is tricky right now due to the fact that, yes, even though we've established the underlying trend is bearish, we still haven't seen a breakdown below 177, 175 major support, and price is still too close to that level to warrant a bearish trade. So in this case, it may be best to sit on your hands, wait for something to happen. Either wait for a rebound and a rally back towards 184, which is the next level of horizontal resistance, which will provide another good shorting opportunity, or you wait for a breakdown below 175, where you can see price continue lower towards 171. I do think price should reach the 177 level in the next few days, given there is some underlying weakness. But again, the risk to reward doesn't really provide a good bearish setup right now. And oil is continuing to move higher. Strong breakout. Above 80, this 81, 82, 83 level of resistance, that's the major level that we've been looking at for the last few months. And ever since price broke above 74, we identified that 82, 83 area. And I was looking at potential shorting opportunities. But again, for those of you that have been following me for the last few weeks or last couple of months, I did mention that when price was at 83, I didn't like the price action that was showing over the last couple of weeks, during that time. It didn't really show very bearish price action like it did in the other times or instances where it reached the 83 level, 82, 83 level, and showed some clear bearish price action. Here, it just looked like price it was very reluctant to move lower. We did get a bit of a breakdown, but again, immediately finding support at 78, also the 55-day exponential moving average, and then price did continue to move higher here. And it's moving higher with strong momentum. So back above 86 now, that's quite significant strength here for oil. I think there's potential for it to move higher here. Consolidated in the last few days. If we see a breakout and a close above 88, that would open the door for a revisit of around, let's say, the low to mid 90s. But things still looking quite bullish here for oil. Supply cuts are definitely working. And despite the fact that Chinese data and potential for a reduction in global demand is there, the supply cuts seem to be outweighing that for now. All right, sector rotation. We have 7 sectors in the improving and leading categories, and we have 4 sectors in the lagging and weakening categories. So the leading category, new entry, and that is energy. The energy sector, no surprise that it has rotated from the improving into the leading category due to higher oil prices, and showing some good relative strength and momentum. In the weakening category, we have technology. So technology continuing to underperform. And that speaks to the fact that, the NASDAQ 100 that has so much exposure in technology stocks is also slightly underperforming the S&P. It doesn't mean you have to be bullish on the S&P and bearish on the NASDAQ, but we are still seeing the fact that rotation out of technology and into the other sectors, that is showing up on this chart as reduction here in terms of relative strength. It may not last very long. We know that technology provided very strong levels of leadership over the last few months. So it's only natural to see that rotation away from technology every once in a while. However, for now, we are seeing technology actually not performing too well. Communications, on the other hand, making a bit of a comeback, improving relative strength and momentum, may even head closer towards the improving and leading categories. And we have discretionary rotating out of the leading category and into the weakening category, again, after being in the leading category for quite some time. In the lagging category, we only have staples. It did have a bit of a slowdown in recent weeks, but still looking like it'll eventually rotate into the improving category. But if you compare it to the other defensive sectors like utilities, which is pretty much the same as staples, it is in the improving category, but again, not by much. But if you compare it to healthcare in the last couple of days has seen a bit of a resurgence. And we actually have a healthcare chart to take a look at, which is the next slide. But I think healthcare as a defensive sector might be the best one compared to staples and utilities to take a look at. So we'll look at that a bit more in the next slide. But healthcare performing quite well in the improving category. Industrials, a big shock here because it looked like for a month or so it was going to rotate into the leading category and it has now immediately lost out on that momentum, heading back down towards that lagging category. And financials staying somewhat steady. May head into the leading category quite soon as well, but again, not as strong as the likes of energy, for example. Okay, so XLB, the healthcare sector. I think there's a bullish opportunity here for healthcare. Very choppy price action, yes, no doubt about that. But looking at the bigger picture on the weekly time frame, what I'm seeing here is a bit of an upward trend defined by higher highs and higher lows. Yes, there's a strong level of horizontal resistance, but it does look like price is squeezing that level and could eventually break out to retest 142.50. Now, moving on to the daily time frame, we have minor support at around 130. Price did come back to that level and immediately bouncing. It's now at the 21 and 55-day exponential moving average. But if it can break above that, I think that gives a nice green light for a continuation towards 137. And if it can break above 137, well, like on the weekly chart, we have 140 to 142 levels to be looking at here for healthcare. So good risk to reward, bullish opportunity. And we are seeing in terms of the defensive sectors, healthcare is the best defensive sector compared to staples and utilities. All right, XRT. XRT was an old idea from 2 weeks ago. I was looking at a bullish play here when price is at around, let's say 63 or so, because I saw initially a bounce from 62. It was working well, looking like it was going to break above that 21 and 55-day EMA. Since then, it has come back. Now, price hasn't invalidated the bullish thesis because it's still above 62 level of support. But what I don't like is the fact that it's approaching this level with a lot of bearish momentum. We're not seeing a lot of bullish price action. And if we don't see it, or if anything, I'd probably be looking to close this trade now for minimal loss, just because of that lack of that bullish price action at a key level of support. It does indicate that there could be a breakdown, or even if prices continues to move neutral at around 62, sort of very profitable strategy. So I think it makes sense to actually close out the trade early and unfortunately, take the loss, but that is trading. All right, so moving on to some market observations. I only have one new idea for today, but we are going to be taking a look at some previous ideas. And the first one is McDonald's. So 2 weeks ago, we were looking at McDonald's trading at around 285.86, and it was rejecting the 21-day exponential moving average. So I was looking for a nice move lower, and we did get a nice move lower towards 276. So price actually breaking below a horizontal level of support. However, it is coming back to retest. Now, usually I would say good time to take partial profits, sure. However, taking a look at the 50-day or the 50-period CCI, what I'm seeing is positive divergence. So momentum is making a higher low, as you can see here, but price has made a lower low. Now that is positive divergence, and that's usually a very bullish sign or very bullish signal. Not immediately, but it does indicate that capitulation could be on the cards. And for that reason, I would just say it makes sense to actually close out the entire position for a good profit, because again, we entered this trade at around 286, 87, when price, or 284 even, if you're being conservative, when price was rejecting that 21-day exponential moving average, and we did get a significant move to the downside. So even though at 276, that would have been a good time to take partial profits, I think it makes sense to close the entire position now, given the fact that we are seeing positive divergence. Okay, BMY. BMY, again, another bearish idea that we had when price was at around this level, just above 62. It was rejecting that level. It did come back to kind of potentially break out, but again, ran into that 55-day exponential moving average, which has been providing this very strong resistance level, dynamic resistance level, as you can see, and immediately did move lower, back below, back down towards this major level of support at 60. That is the take profit zone, in my opinion. There's a chance that price could break below that. And again, we're already seeing a strong rejection of the 21-day exponential moving average yesterday. But you don't want to be too greedy with this. This is still a major support level, so it makes sense, in my opinion, to take profits on the full trade. Okay, Johnson & Johnson. This is a longer-term bearish play. We were bearish at 173 due to the fact there were multiple rejections, and we did see a strong move to the downside, followed by consolidation, followed by another move lower. Now, at the time, I did say 164, great time to potentially take some partial profits and leave the rest of the trade to run. And it did reach our 158 downside targets, pretty much on the dot, and immediately bouncing higher. This is very bullish price action from a level of support. So in my opinion, it makes sense to completely close this position. It looks like we could be getting a change of trend here. But either way, this was a trade that worked very much in our favor here, and we really got a nice downward move. And also, given the fact that healthcare is now improving, you don't want to be bearish on Johnson & Johnson either. Okay, new idea, and that is Royal Caribbean. Bullish idea. And as you can see on the weekly time frame, there's been a lot of underlying strength since July. Obviously, with the reopening of tourism over the last couple of years, this was always going to happen. We knew that, I always was looking at cruise liners as a potential long-term bullish play, given the fact that we're trading so low, even 2 years after, COVID-19. So we have seen a strong move higher here. On the weekly time frame, we saw price actually rallying all the way from 60 to break above 97. And since then, we've seen a pullback. But a pullback and retest, and so far it's looking like a successful retest here. Multiple intraday rejections of 96, and this provides a good risk-reward bullish opportunity for continuation higher, targeting that 112 level. But yeah, this is a simple breakout and retest, and a retest bullish entry move here. So let's see how this plays out over the next few weeks. Okay, Oracle. Oracle was a bullish idea with 114 acting as support, our thesis for the trade. I did say take partial profits at around 120, given the fact that it was still somewhat neutral above, even though it was respecting 114 as support, it was still not really breaking out of 120. But we have since seen a breakout, and now price is back at 128. A bit of a double top here, but not really showing that bearish price action. So we could very well see a continuation higher. But that being said, it also makes sense to take profits at this level. This trade has been on the board for quite some time. So partial profits at 120 and 128, a nice place to be taking full profits. Also, 50-period CCI is at an overbought condition. So we could see a short-term reversal here in price. And finally, we have Roku. Roku was a bullish idea. And it was a bullish idea that required a lot of patience, because we were bullish when price was at around that 78, 79 level, and actually broke down below that line, but found some support at the 55-day exponential moving average, which is why I wanted to keep a hold of it. And we did see a strong move to the upside, price reaching the 96 area, but immediately coming back down. So we are seeing some rejections of 88 as well. And in my opinion, it actually makes sense to completely close out this trade. If you got out at 96 or somewhere around 96 or 95, then fair play. But the fact that price is still reluctant to move that much higher, and given the fact that this was also a potential debit spread idea, you'd want to see a stronger move in your favor for this strategy to be profitable or the strategy to work well. And we're not really seeing that. So in my opinion, it does make sense to close out Roku for pretty much a break even. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you next week, Tuesday, for another market outlook. Goodbye, everyone.